It's the last day of the trading week, but we still have plenty more exclusive interviews for you. I'm Natalie MacDonald, and on the phone with me now to discuss his expectations for Canada's GDP data, released today at 1:30 GMT, is Colin Cieszynski of CMC Markets Toronto. Colin, today's GDP data is expected to come out at a negligible rise of 0.1%. Is this a forecast you would agree with?
Yes, this is the monthly data for October, so it's basically suggesting that the Canadian economy stayed relatively flat during the month with perhaps a little bit of growth. The Street's also looking at 1.2% growth over the same month a year earlier. And it's important to note previously in the last report, the Street was also expecting 1.2%, and it came in at 1.0%. So a little bit, it was actually last month was a little below expectations.
The International Monetary Fund recently cut its GDP forecast for Canada for next year to 1.8% from its initial 2% prediction. What are the anticipated drivers behind this expectation?
There's two things primarily for Canada. First of all, as an exporting nation, we are susceptible to changes in the forecast for global growth. So with the global economy continuing to struggle into 2013, then clearly Canada does face a bit of an impact from that. And when the IMF did cut forecasts, Canada wasn't in isolation. It cut forecasts for pretty much everybody.
Analysts have anticipated that interest rates will hold steady in Canada through 2013, but that Governor Mark Carney's successor will nudge rates up 50 to 75 basis points in 2014. With growth not expected to pick up until late in 2013, are these forecasts realistic to you? Similarly, what role does Carney's exit play in these predictions for 2013? Is there concern in the markets?
Not at this point in time. I mean, certainly Governor Carney has been a fairly strong governor of the Bank of Canada, but he's also continued to follow policies that have been in place since the early 1990s, including things like inflation targeting. He's continued to build on that, particularly during the financial crisis when he started to talk about how long he would keep interest rates at a certain level for a certain amount of time. In late 2008, he had said that he would keep them low through 2010, which he did before he started raising them. So he's continued a trend and a process that's been going on at the Bank of Canada for some time, and certainly has continued to be very successful. But there is a feeling there also, though, that whoever potentially comes in may also continue his work. We're not expecting any major changes to monetary policy or transparency going forward. It would likely be more of a stay the course kind of situation. The change in interest rates is unlikely through 2013 for a couple of reasons. First of all, of course, the Canadian dollar has remained strong. It's continuing to trade above par. The Canadian economy is growing, but at 1 to 1.2% over the year isn't huge growth. It's just kind of muddling along, and flatly right now has been growing at a slower pace than the United States, which just this morning had put up some fairly strong GDP numbers for the third quarter. So there doesn't seem to be any real pressure on the Bank of Canada to raise interest rates at this time. And the other thing was in the case of the Canadian housing market, where we had seen a bit of overheating, they've taken more structural measures to try and cool that down, such as changing the terms on mortgage rates rather than doing it through interest rate policy.
The Canadian dollar has been up against the US dollar off the back of better than expected Canadian retail sales and US GDP figures. The overall sentiment is bearish on the dollar CAD towards this release, but what are your forecasts?
At this point in time, I expect the Canadian dollar to continue to remain strong. We're starting to see capital flows out of the United States, basically because it had been such a defensive haven for so long. Capital is starting to flow back out of the United States and back towards Europe. It's also starting to go back into equities and back into commodities. So we may see a little bit of these outflows from Canada, but at the same time, the U.S. dollar has the potential to weaken in the near term, so these may offset each other.
Thanks very much, Colin. That's all from me for now, but stay tuned to Dukascopy TV for the all-important weekly wrap-up interview. Goodbye for now.